You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is managing partner of Wellings Capital, Paul Moore. Now, after graduating with an engineering degree and an MBA from Ohio State, Paul entered the management development track at Ford Motor Company in Detroit. After 5 years, he departed to start a staffing company with a business partner. They scaled and sold this company to a publicly traded firm 5 years later. After a brief retirement, Paul began investing in real estate in 2000 to protect and grow his own wealth. Now, Paul has completed over 85 real estate investments and exits, rehabbed and managed dozens of rental properties, built a number of new homes, developed a subdivision, assisted with the development of a Hyatt hotel, and finally, a very successful multifamily project in 2010. All this collectively convinced him of the power of commercial real estate. Now, here's what you're going to learn in our discussion with Paul today. You're going to learn how he got to start as a real estate investor after a successful exit from a business that he founded years prior. You're going to learn about the worst real estate deal that he's ever done and how he lost more than $300,000 on a bad deal that took him more than 13 years to exit from. You're going to learn why Paul shifted from being a multifamily investor to focusing solely on mobile home parks and self-storage assets. In fact, he even wrote a best-selling multifamily book a few years ago called The Perfect Investment and has since gone back on calling multifamily the perfect real estate investment. And again, now focuses solely on mobile home parks and self-storage. You're also going to learn about his long-term outlook on how COVID will impact real estate investments, more specifically multifamily and mobile home parks. You'll learn about the major risks associated with self-storage investments and how to mitigate these associated risks, and much, much more, guys. And so with that, I'm excited to get onto it with Paul. But before we do, I just have a few quick housekeeping items I'd like to run through. Now, guys, it's been a long time coming, but I'm excited to announce that we're putting the final pieces in place on the offering docs for our third mobile home park investment fund, which we expect to be live in the next week or so. Now, take this as your special invitation to get on our priority notification list for when this offering goes live. You can simply go to our website, sunrisecapitalinvestors.com, and click on the Get Started Today button and fill out the short form to get placed on our email notification list. Now, we have a number of exciting off-market deals that we've been diligently working on behind the scenes here, and we look forward to getting things rocking and rolling again and having the opportunity of working with you. So again, go to sunrisecapitalinvestors.com and click on the Get Started Today button. And now moving forward here, just want to remind you of the partnership program that we launched a few months back called Bring Kevin a Deal. And this is where we will pay a referral fee of up to $200,000 for any mobile home park or parking lot deal that is referred to me that we end up buying. To learn more about this opportunity of working together and to also download my deal acquisition criteria that runs through exactly what we're looking for in either a mobile home park or parking lot investment, you can go download that by going to bringkevinadeal.com. Again, that's bringkevinadeal.com. Guys, if you love what we're doing here at the Real Estate Investing for Cash Flow podcast and you haven't done so already, please leave a rating and review on the show. And also be sure to subscribe so that you are made aware of when new episodes come out. Lastly, before we get on to the show with Paul, I just want to remind you of the free 30-minute phone call that I offer each and every Friday. This is where I set aside 2 or 3 30-minute time slots every Friday, and I've been doing it now for going on 6 years where you and I can connect, okay? This is a way for me to connect with the listeners and to find others that share the same passion for real estate investment as I do, okay? I love talking to others that are into the real estate investment space and really enjoy and share a passion for this space. Whether you're brand new or you're a seasoned pro, it really doesn't matter. I've met hundreds of you now over the last 6 years, and I look forward to hopefully meeting you. So go to my website, kevinbupp.com, to get signed up for that free call. Again, kevinbupp.com, and get signed up for that free call. And now, guys, without further ado, I'd like to get on to the part of the show that you've been waiting for, which is our interview with Paul Moore. So here we go. Alrighty, guys, it is my honor to introduce my guest for today's show, co-founder and managing partner at Wellings Capital, Paul Moore. Paul, how you doing today?
I'm doing great. How you doing, Kevin?
Doing awesome. Even better now that you're here with me, my friend. So looking forward to having you here. I know we tried to get this together for probably 8 or so months. I know I canceled you canceled on me, and we went back and forth, but now we're here. That's all that matters. So excited to have you back. I know that it's been a couple of years since I had you on last time. I didn't look back and see what episode number that was, but I know that it's for a fact been at least probably 2 years. And so with that being said, Paul, what I'd love to do for folks that might not have listened to that episode, might not know who you are or what you're all about and what it is you do, maybe take a few minutes and just tell us a little bit more about yourself and your background.
Yeah, absolutely. So I sold my company to a publicly traded firm at 33, and I put a couple $1 million almost in my bank account. And I looked at myself as a guy. So I went and started a nonprofit, but I considered myself a professional investor. And the truth is, I was a professional speculator because, Kevin, as you know, investing is when your principal is generally safe and you've got a chance to make it grow and earn income from it. Speculating is when your principal is not at all safe and you've got a chance to make it grow and earn income. And so I speculated on a lot of deals. I made some money. I lost some money and learned a lot of hard lessons. I mean, after all, I've got a podcast called How to Lose Money, right? But anyway, I started investing in real estate a couple of years later. I've been doing it for about 20 years now. I've done all kinds of residential, lease to owns, ground up construction, did a small subdivision, built a large multifamily project and operated that for years, helped build a Hyatt hotel. And through all that have really realized where my weaknesses are. I think more than my strengths. I mean, for example, when I built ground up homes, I didn't know that, somebody who doesn't know how to tighten the doorknob on their own home shouldn't be a builder. But hey, I thought I could sub it all out, and the subs realized they could take advantage of me. And of course, that was been almost 20 years ago, but I learned a lot of lessons along the way for sure.
Well, good deal. I appreciate that background. And I love to ask the question, what was the worst deal? So back when you were a speculative investor, before you came over to the better side, tell me about the worst deal. What was it, and how much money did you lose?
Yeah, the year was January 2006. And the month and year, I should say. And my business partner and I were flipping waterfront lots at a place called Smith Mountain Lake in Virginia. It's sort of the Tahoe of the East Coast. And he did not like this one lot. And I was like, but this is a beautiful, country club community. And there's hardly any lots in the 300s because we'd already sold a lot or two there for like 500 or something like that. Lots in general were going for $500,000 or more. And so I bought this lot for $330,000, and he did not want to be part of it. And so I realized after not very long that I had made a mistake. Well, of course, it was 2006, and the economy was starting to teeter. 2007, 8, 9, 10, 11. I had the lot listed for about 13 years.
Wow.
And, right after that, the economy tanked. And after the economy tanked, the country club that this was part of became kind of like, it didn't go into disrepair at all, not at all, but it just went out of favor. I can't explain why, it just did. And so even when the economy came back, the country club wasn't real popular. So I had pumped incredible amount of interest. I had paid off the loan, thankfully, so I had it for cash. Anyway, long story longer. I finally decided, I had it listed for like $260 for years off and on. And I started dropping it $1,000 a day till it sold. I didn't care.
Oh my gosh.
So I got down to 340. No, 140. And 140, and I finally sold it, and I lost like 300,000 on it at the end of the day, at least.
Wow, 13 years later too. That's incredible. Has that lake area, has that come back? I mean, is it prior to COVID? I mean, is it a booming area now, or again? I guess you could say
prior to COVID, it was a booming area, but the speculative nature of lots was not there anymore. I mean, like, we were able to buy a lot like for a fair price in 2004, go and trim the trees, clear it out, get it ready for a home site, get a dock permit, 6 months later, sell it for $120,000 profit. And nothing like that exists at all. But I'll tell you, since COVID, I still have a website there, smithmountainhomes.com, where people can go and check out houses, and then I sell the leads to realtors. And I predicted it was just going to go in the tank in March. And the truth is now, houses are selling the day they hit the market. I mean, it's crazy.
I bet people are getting the hell out of the cities right now is what's happening.
Yeah, we're close to Raleigh and DC and all the other cities, in this part of the country like that. And some, even as far as Philadelphia and Connecticut, people are coming down here. Kevin, I heard that 400,000 people have left New York City in the last 6 months. Is that true?
It's amazing. Yeah, I was actually looking at the UHaul stats, and like they've literally had the busiest months on record the last 3 months of folks moving out of New York City, and also larger cities such as Chicago and Boston, and there was many others on that list, but New York being the largest of them.
Wow.
Yeah. No, it's absolutely crazy. And I'm not one to think that, New York is never coming back or it's literally going to die. I think it's got a lot of challenges ahead of it, not even just related to people moving out because of COVID, but all the civil unrest and just lots of other factors there. The whole defund the police movement, again, not to get into the political show here, but just I think it's got a lot of our challenges, as do a lot of the other larger major metropolitan areas. And so time will tell, but I think, I think ultimately it will come back and those areas will thrive again. But I think it's going to take some time for that to occur. And I think people now realize that, especially now they can work from home, right? That's one of the big changes. Right. Now they know, like, hey, I don't have to live in the city, and I'm okay not having this 900 square foot apartment that costs me $8,000 a month, and I can literally live an hour away and have a half an acre of land with a big yard and a swimming pool, and not be stuck in the same room with the kids out now that have to get homeschooled or virtual schooling and go crazy. And like now I can have more space, and that I like that. I can appreciate that now. And so anyway, so the interesting thing is, as we lined up this interview, and again, it's taken us some time to get back on the horn together, but lots changed in this world, but not just in the world, but also with you. Last time we had you on, I think you had just published, or maybe sometime in that time you had just published your book, which was called The Perfect Investment. Back then, you were hot and heavy into the multifamily asset class. And that's changed. And so please bring me up to speed as to where you're at today, what you're investing in and why you left multifamily.
Yeah, so it's funny. I looked at the demographics, the long-term future, the risk and return, the default rate, and all that stuff in multifamily. And I came to the conclusion it was the perfect investment. And not a humble title at all to the book. The original title was The Definitive Guide to Multifamily Investing. And
that's a little more boring.
Somebody told me it was boring, and they said I needed to go for a Think and Grow Rich type of title. So anyway, but I looked at all that, and Kevin, I think it was and is the perfect investment, and everything I said in the book's true, except one thing I missed, and that is it's not perfect at all if it's overheated. And let's face it, multifamily investors all over the country are realizing, hopefully, that prices are way overheated. And by the way, I could be wrong. If cap rates continue to compress, interest rates continue to hover near zero, maybe in the end, it'll be proved that these prices, the 4% cap rates and all that, are reasonable. Just not for me. I realized, like I'm in my mid-50s. I don't want to take a chance I know I don't look it, but I didn't want to take a chance at paying for an investment. And I'd done enough of that in the past. So we decided to expand our focus, and we were thrilled when we discovered mobile home parks and self-storage. And so we still believe in multifamily at the right price. But right now, Wellings Capital has been focused on mobile home parks and self-storage. And we really appreciate you for all the education you've given us and, through this podcast and through all the stuff you're doing, Kevin, because this has helped us and helped our investors understand this asset class that was not understood for so long.
Yeah, no, I appreciate that. And it is a wonderful asset class, no longer under the radar like it was, 7-8 years ago, unfortunately, but, it's still a phenomenal asset class. And, we're equally as excited about it today as we were, 8-9 years ago when I bought my first park before we, built Sunrise Capital Investors. So phenomenal asset class. And just to add some context to the multifamily background, where were you guys investing in the multifamily space? I know we probably covered this before, but just refresh my memory as to what parts of the world you were in.
Yeah, we were looking for Class B value add, between 80 and 150 units. And I actually built a ground up. I mean, I wouldn't call it a Class A even the day it was built. Thankfully, it was like more of a workforce thing. We did that in Watford City, North Dakota. And that was during the Bakken oil boom when 10,000 or so people descended on a town of 3,000. And we were charging hotel rates, which was $129 or so per night, which turned out to be $4,000 a month for a full utilities and fully furnished 300 square foot room. And so that was really fun. And we did that for years, and it went really well. But, Kevin, that ended really well for us. But if we would have waited 6 more months, it would have ended terrible, because oil prices went from 100 down to like $30 a barrel. And that was part of my reasoning for getting away from speculating and into real investing. And so that's why I wanted to stop trying to hit home runs. And I really wanted to start trying to hit singles and hopefully occasional doubles.
Yeah, no, I agree. And I've actually got some good friends that they're not in North Dakota, but they're down in down in Texas, Midland, Texas, what have you, and that whole oil region. And they've got a number of RV parks, and we're absolutely crushing the game of life up until a few months back when things shifted for the worse. And ultimately it will come back. It will take some time, but just the ebbs and flows that exist in spaces like that or niches like that, just I don't have the stomach for it. Some do. I surely don't. I like much more of a stable play, and knowing that the cash flow is going to come in and day out. And so it kind of leads me up to where we're at today. More specifically, during the pandemic, obviously there's been parts of the real estate sector, different asset classes that have taken the brunt of the hit much harder than others. Hospitality and retail is absolutely getting its butt kicked. Even senior living, which, I think senior living is still a really solid bet for the long run, just with the aging population. However, there's been concentrated hits in the senior living space with the COVID outbreaks. And so even then, senior living's taken a little bit of a hit. And, a couple of the asset classes that have not seen that hit, at least not enough to even, to be concerned about, are multifamily, mobile home parks. And you could really classify it all, lump it together as residential rental real estate, right? It could be single family homes even. And all that's really due to, the stimulus that the government passed, the $600 a week additional unemployment benefits, and a lot of folks that were out of work, either making equal to or sometimes even more than what they were at their job and what have you. But at some point in time, that stimulus at phase 2 haven't figured that one out yet. They're still working on that, but it will be something. We can all agree on that, and it will probably be something until election time. But what are your thoughts as to the longevity? And do you think there will be pain felt at some point in time or another? Again, whether it be mobile home parks, multifamily, or just residential rentals in general, do you think there will be pain at some point?
Kevin, I don't see how to avoid it. Yeah. I mean, I love the fact that mobile home parks are, the only asset class I know of that have a shrinking supply and an increasing demand every year. Mm-hmm. I love the fact that they're at the bottom of the housing totem pole, and so when people are downsizing, they land there or they land under a bridge. I love the fact that they're sticky tenants. People aren't going to typically spend $5,000 to move a home where they're paying $300 or $400 in lot rent. I love all those things, but I gotta wonder, if the pain won't be felt. I mean, in the mobile home parks we've invested in, from what we're hearing, there's a waiting list growing a lot, but that doesn't speak to the fact that it'll be hard, it'll be harder for some people to pay rent. And so I think it's going to be harder to manage multifamily, self-storage, and other asset types like that in the coming years. But I want to be clear, I don't know. I mean, Warren Buffett says he can't predict these things, so I'm surely not going to try.
Has your guys, is that with Wellings Capital, has your investing activities changed at all over the last 4 or 5 months? I mean, just generally speaking, have there been any shifts internally with how you're looking at opportunities, how you're vetting sponsors, different parts of the country that you're seeking investments in? Has anything changed at all? And if so, what?
Yeah, so we have a growth and income fund. We call it the Wellings Income Fund, actually, and that's not changed. We just kind of doubled down on making sure we kept our criteria, just held with the criteria we have to invest. We have a growth fund that we were already really, really careful. I mean, just very skeptical of every deal. It included ground up deals. And it includes ground up and steep value adds. So we've just been even more careful in the growth fund. And frankly, we haven't invested anything through the growth fund in a long time. And COVID has certainly fueled even more skepticism on our part. And we've gotten really good at saying no.
Yeah, no, that's a good thing. It's a good skill to have. As far as the pricing is concerned, I mean, obviously, we've been in the space a little longer than you have, the mobile home park space. And so we've seen the downward trend of, cap rate compression, really, and it's due to I just say that's due to the secret getting out. Mobile home parks have always been great investments. They were never really considered as real investments by professional operators in the multifamily space or institutions and things of that nature. And that's completely shifted gears. And, along with that comes, the, larger groups, what have you, paying higher dollar amounts, willing to take, smaller yields on their return for that same investment that you and I might be looking at. And so what have you been seeing on your side, on the buying side? I know you guys aren't directly involved in the buying. However, you're directly involved with the different sponsors and groups that are buying. Is there still a good yield premium to be had when compared to, let's say, multifamily in the same markets that you guys own parks in?
That's a great question, and that really leads me to talk about a strategy that I love, that I know you're very familiar with, but that is the opportunity to acquire mom and pop owned assets. Now, Kevin, in multifamily, 50 units and above, from what I understand, 93% of them are owned by corporations. And they've already wrung out most of the value. They've done the major value adds on those 1970s and 80s apartment buildings, 93%. But in mobile home parks, about 90%, we believe, are owned by mom and pops, individual owners. And a lot of them are really old and they're ready to move on. And they don't have the desire, the knowledge, or the resources to upgrade these, to maximize income and to maximize value. They don't have the money to bring in, to backfill 50 lots with mobile homes. They don't know about how to use 21st mortgage and all that stuff. And so these mom and pop deals are leaving a great opportunity. It's an opportunity, as you know, to pay a very fair price to the seller, more than they ever dreamed, especially since cap rates, compressed, like you said, over the years, and still have a lot of upside by passing back utilities, by, raising lot rents, a reasonable amount, maybe up to market level, by adding boat and RV storage on vacant acreage, by filling occupancy, like I mentioned. And so I think that is the best strategy. And so I'm going to be looking, we, Wellings Capital, we're looking for operators who have an amazing acquisition strategy, who have an inside track on finding these off-market deals.
Yeah, no, fantastic. Has there been a certain part of the country that you guys have honed your focus in on, or that your sponsors you're working with have honed their focus in on?
No, so I'm writing a book about Warren Buffett and real estate investing. And in there, I've learned that Warren, he basically finds a great management team, then he trusts them to run everything. And so Wellings Capital has taken that attitude. We're really focused on finding the experience, the great management team, and then trusting them to figure out the geography.
Yeah, no, that's a great approach. And, it kind of lends me to my next question regarding the structure of your company. you guys are, I would classify you as you're a passive side of the investment arm. Wellings Capital, you guys operate multiple funds. You essentially, tie the limited partners, the passive investors together with the general partners and the sponsors, the ones that are going to actually, to run the show. They're going to run the day-to-day operations. They've got the infrastructure, the management team in place to go not only find deals, but also operate the day-to-day of the mobile home parks. And so talk to me about the, Wellings Capital, the structure, what that looks like internally. How do you work with sponsors? How do you work with limited partners? And, kind of what's in it for you?
Yeah, so we come in as an LP investor with these sponsors, and so we're basically a limited partner, which means we don't get the loan in our name. It means we don't have the decision-making authority. We're loving these people so much that we're trusting them to make the decisions, like I said. And we're often coming in as a very large investor. So recently we came in, the largest investor in one of the portfolios we invested in was the owner, the general partner, and I love that. But we quickly overtook him, and we have invested. I mean, he had invested the first $3.5 million out of $15 million in this portfolio a year ago. As of now, a year later, we've put in like $20 million of the current $50 million in the portfolio. And so, as a large investor, we have some sway with him, even if it's unofficial. And we also get a premium from him because we're, investing over $1 million in that case. We're getting the very best split and a better split than the investors would typically get. And so therefore, when we pass that better split along to the investors, it more or less offsets our fee. We charge an admin fee going in and then an annual admin fee. And then after the investors are paid very well with like a 9% preferred return, for example, after that, we have a profit share above that split level.
Got it. Fantastic. And are you currently investing in self-storage as well? I know you mentioned mobile home parks and self-storage. Is that an asset class that you're also spending a good bit of your time on?
Yeah, we are. In fact, I just wrote a book on self-storage investing. It's coming out from Bigger Pockets Publishing, hopefully by the end of the year. But we love self-storage, and it's actually done really well during COVID as well, Kevin.
Yeah, I need to find out. Your secrets about writing so many books. How you knock them out so quickly.
Well, I mean, 4 in 10 years isn't that quick.
Yeah, that's true. Fair enough. So let's talk about self-storage. That's one asset class. I do have some investments in from a LP perspective, but it's one that I've never owned. It's one that I really, really like. But what are you seeing as far as the performance during COVID? Have you seen things be operationally sound, collections strong, or the opposite?
Yeah. So, collections are about the same as they were pre-COVID. There's about we're seeing like a 6 to 8% default or delinquency rate, not default, and so people paying late or whatever. But no, we're seeing that. Think about restaurants shutting down, but maybe not for good. And think about retail, and think about offices who are, thinking about downsizing now. They need a place to store their stuff. And, in good times, people, are filling up their Amazon and Walmart carts. They need a place to store some of that stuff. They're inheriting stuff from their parents as they pass away, like mine did, and needed a place to store some of that stuff. In bad times, people are often downsizing, and for a really small percentage of their income, unlike their rent, when they downsize, they can store their stuff until they get either back on their feet or sell that stuff. And so the cool thing is about self-storage is the tenants are very sticky, like mobile home parks. I mean, if I raise someone's apartment rent, or I'm charging them $1,000 a month and I raise it by 6%, they may go somewhere else rather than pay that $60 a month and lock in for a year. If self-storage is, if I'm renting them a unit, the same people a unit for $100 a month, and I raise it by 6%, well, they may be irritated, but chances are they will not take a Saturday, rent a U-Haul, get their friends together to move down the street to save $6 a month.
Yeah.
And so we really, so far, so good. We really think that self-storage is going to continue to perform well, except in areas where it's overbuilt. And there are places where it's overbuilt, places like Boise, Idaho, where there's like literally 2 to 3 times as much storage as needed.
Wow.
That's going to take years for them to come to equalization, you know?
Yeah, I was going to ask, what are some of the big risks with self-storage when compared to mobile home parks? I mean, we know mobile home parks, it's got not a lot being built, lots of barriers with regards to getting approval from municipalities, just not really in the municipality's even best interest to allow a mobile home park to be built from a tax perspective. Right. And I mean, lots of other factors there, the not in my backyard syndrome. And so with self-storage, that's not necessarily the case. There's not those different barriers there. And so I'm sure that's obviously one of the big risks, but are there any other risks associated with that asset class other than being overbuilt?
Overbuilt is the number one. I mean, like you're in a great market. Let's say you're in Bradenton, Florida, and you're building right by Lakewood Ranch, this amazing community there. Let's say you have a place that's 50% occupied, and then another Life Storage or Public Storage or somebody with deep pockets comes in and builds right down the street. Well, that could really hurt. And so that's the number one risk, is the time where you're trying to lease it up and the possibility somebody will come in during that time. Other risks, honestly, that's the main risk. And I hate to sound that way because it sounds like I must be hiding something, but there's not, the lease up phase and the competition. Part of the problem is, unlike mobile home parks, it's so easy to get approval and build a self-storage facility.
Mm-hmm. How about the consolidation in that space? Again, still a lot of mom and pops in the mobile home park space, not so much in multifamily. What does that proportionate share look like between professional operators and owners and the mom and pops? Because at the end of the day, back in the, I guess, was it 70s when self-storage or mini storage is what it used to be called, came about, it was 100% a mom and pop industry until public storage was the first large group to enter into that space, correct?
Yeah, as far as I know. Yeah. And they are huge compared to the other REITs. I mean, they've got I think it was 2,600 facilities or something, and compared to the next largest being like 1,200 or something. So I mean, they're definitely the giant. But there's only 7 or 8 really large institutional players. Some would argue 15, up to 15, but they only have about 10 or 12% of the market. The other 88% is split between what I would call large independent operators. And that would be people with, maybe 2 to 25 facilities. And then there's a whole lot of mom and pops that have 1 or 2 facilities. And so I believe that statistics I've seen say 76% are the independent operators, and of the 76, like 50% are mom and pops with 1 or 2 facilities.
Got it.
So it's still...
So there's still an opportunity there with the mom and pop. I mean, just the same approach with mobile home parks. There's still an opportunity there, I'm guessing, with the mom and pops that haven't really, they haven't adopted all the latest and greatest technologies. I'm assuming a lot of the big operators out there have dynamic pricing models, right? They can adjust on the fly, and mom and pop that uses paper and pens and filing systems, big filing cabinets, they surely don't have that ability. Is that some of the sponsors you're working with? Are they kind of going after that same type of target market with the mom and pops on the self-storage side?
Yeah, there's actually mom and pops who have not maximized their location is much better than their operation. So I'm thinking about one right now I went to in Marietta, and another one in Roswell, Georgia, where these were sleepy little towns in the 70s when these self-storage facilities were built. And now they're booming metros of Atlanta, North Atlanta. Mm-hmm. And so their location is phenomenal, but they're still running it, I won't say with pen and paper, but they might be running it with spreadsheets. They're not using the dynamic pricing. There's also a dynamic sizing as well. You can look at your demand for 10 by 10s versus 10 by 5s, and you can say, hey, you know what? The demand for these smaller units is more. We'll just go in and we'll add a door, and we'll cut these units in half. Well, a professional would do that, where a mom and pop rarely ever would. A lot of these mom and pops also have extra land, so you can, maybe have an extra acre on the side. You can add a 2 or 3 story climate controlled facility. They don't have websites. They don't do truck rentals. Truck rentals alone, Kevin, can take a marginal facility and make it extremely profitable. So it's very powerful value adds. Adding a showroom where you can sell locks, boxes, tape, and scissors, things like that.
I always wondered about the U-Haul side of that business, if that's a really profitable component add-on, or is it more of a loss leader just to get additional traffic in the door? So you think you answered that question for me, that it is a profit center.
Yeah, I mean, so real quick. So let's say you bought a $2 million, let's say a $3 million self-storage facility, $2 million in debt, $1 million in equity, right? And you're in a really good location for U-Haul. Let's say you add U-Haul and it adds, on the high side, it could add $5,000, but let's say $4,000 a month in commission. $4,000 a month, as you know, is $48,000 a year added to your net operating income. $48,000 a year divided by a 6% cap rate, if I'm not mistaken, is $800,000. You just added 80% to your value of your equity. You had $1 million in equity. Now it could be 1.8 if I did my math right. That's pretty powerful.
That is powerful. Interesting. No, that's great. I never realized that there was that much power behind the U-Haul. So no, that's phenomenal. I appreciate that feedback. What else related to self-storage or mobile home parks that we haven't hit here today, Paul, that you feel is incredibly important for our listeners to know? Obviously, we talk about mobile home parks a lot because that's a space that we're in. But is there anything else that is of the utmost importance between either one of those two niches that you feel that we haven't touched on?
Well, I mean, just backing up to a higher level. I was writing an article for Bigger Pockets, and I was thinking through again how I used to be a residential investor and how I took a house that was like $80,000 and we just killed it on the remodeling. And somehow it got a little out of control though. And we ended up, instead of with 150 in it, we ended up with like 230 in it or something like that. But it was in a $180,000 neighborhood. And so it was so nice that we got a cash buyer who didn't need an appraisal. And we told him over and over, look, we want to be clear. This is a $180,000 neighborhood. It's the nicest house in the neighborhood by far, but it is overpriced. And he's like, I don't care. And he paid cash. So we got out of that. But that's not normal. I mean, if I'd had to get that appraised, it'd have been hard to get it appraised for $250. But what I love about self-storage, mobile home parks, and other commercial real estate is the value is based on math. And we just did a quick math example 3 minutes ago. But I mean, the math is so powerful on some of these. We're looking at a self-storage facility in Florida right now, just a flip. Just adding U-Haul will take it from maybe a 5 cap on trailing income up to maybe a 9 cap. I mean, and that's before we fill up the 34% vacant units, and the guy doesn't have a website. His marketing budget's zero. He doesn't have a showroom with, selling ancillary items. Maybe it's not even worthwhile in that location. But I just love the math and the value proposition, the value formula of commercial real estate. Yeah. I think that's why the Forbes 400 almost all invests in commercial real estate, Kevin.
Yeah, no, I think you're right. I mean, I was just kind of thinking through a conversation I had this morning with our team on one of our communities. We've got a 153 space community in Mississippi, and we've owned it for about a year and a half, and we've been paying the trash bill, which I think it's like $13 per resident. And we just basically agreed this morning we are going to send out a letter, the first of next month, and we're going to start billing back for the trash. Basically, that goes directly to our bottom line. There's no cost associated with us passing that utility back on the residents. And that is the commonplace in that market. In that particular market, almost all of our other competitors, the residents pay for the trash. It's billed back. And so that alone on that community at a 6.5 cap adds about $360,000 of value just by
amazing
having a 10-minute conversation with the team and drafting a letter and dropping it in the mail.
Right.
Yeah, no, it's incredibly powerful. And there's a lot of opportunities. I think the key point there, and as it ties in with mom and pops, that's where the opportunity really lies. They don't, I'm not going to say they don't understand the math behind it. There's sophisticated mom and pops, some of them, but a lot of them don't understand that additional value that is created by passing those things back. Or if they do understand that, they're scared to do it. A lot of times they've become really close friends with the residents, which isn't a bad thing, but it's a bad thing from a business perspective, right? I mean, they become friends and they don't want to hurt anyone's feelings or get in a conflict or get in an argument with the resident because they're friends with them and they're charging them more in rent, or they're passing back the utilities, what have you. But lots of opportunity there still, and that exists with self-storage as well, as you had mentioned. Again, I'm excited about the U-Haul. That's I don't own self-storage per se, but I have LP investments in it, and I never knew there was that much power behind the U-Haul business model. So very enlightening.
It's true.
So, Paul, this has been a lot of fun. It's always a pleasure having you on the show. And what I'd love to ask of you before we round it out here today is you've shared a lot of great information, lots of gold nuggets. But if you had just one final gold nugget of advice or wisdom that you could leave with our listeners that might inspire and motivate them as they progress on their own real estate investing career, what would that one last gold nugget be?
I think it would be to really evaluate and understand the difference between low risk and high risk investments. Low risk leads to low return, and almost everybody agrees to that. High risk, therefore, must lead to high return, but that's not true. High risk leads to the potential for high return and an equal potential for high loss. If you're an entrepreneurial person and you invest that way, you'll probably ignore, or you might tend to ignore that fact, especially when you're younger, like I did. And you'll think high risk, high return. And, a lot of the folks who have been ground up developers over the years, they're some of the wealthiest people in the world. But a lot of them are delivering pizzas right now. And there's nothing wrong with delivering pizzas, don't get me wrong. But if you really want to progress in your investing career, you might be better off, on average, to follow in the footsteps of Warren Buffett than you would, a high-risk developer, because I just think on average, you'd be better off to grow your wealth that way. Mark Zuckerberg asked Warren Buffett, he said, your strategy is not that hard to imitate. Why doesn't everybody just follow you? And Buffett said, oh, no. Nobody wants to get rich that slow.
Yeah, that's it. Patience.
And, so... That's
amazing. Yeah, no, that's wonderful. I appreciate that, Paul. And for folks that want to learn more about you and get in contact with you, where's the best place to find you?
They can come to my website, wellingscapital.com. That's WELLINGS capital.com.
All righty. Paul, it's been a lot of fun, man. It's always a pleasure having you.
Absolutely, Kevin. Me too. I really enjoyed being on here, and I'm really honored.
All righty, guys. That's all we have for this week's show. And until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.